Let's ask Victoria Greene. She's Chief Investment Officer at G Squared Private Wealth and a CNBC contributor. Victoria, welcome to you. And as you study these trades, first of all, do you have a knee-jerk response of chase it or fade it?
I'm casing a little bit into it. I think this is one of the times that you have a lot of risk out there with a weaker U.S. dollar, falling rates, inflation's a boogeyman, geopolitical risk. You have kind of like a perfect storm flight to quality here, flight to haven assets, which is driving metals higher. Plus, are used in a lot of industrial needs, like you talked about, in technology as well. And my mom's having a victory lap here. All the jewelry she bought as an investment is sure making her feel good about it. so that's a plus for a lot of people on that side.
It's funny you bring that up because years ago, 15 years ago, when I was writing at the Wall Street Journal, we did a story about record high gold prices and people panning their jewelry. And I've noticed this time around the dearth of those stories. I don't see them anywhere. Remember how there used to be signs out front of all the jewelry shops? You know, gold, we'll take gold, we'll trade it in. I have not seen that at all. Are people just inured to this? Do they not know? Do they already trade it in and so they've missed the run?
Yeah, no, I think right now with prices so high, you're looking at it and saying, hey, maybe jewelers aren't really looking to buy as much as sell right here. But for people that have a significant gold or they bought their gold bars at Costco or they've been investing in precious metals all along, this has been a really great hedge. And you can look at that long-term chart of the U.S. dollar and just say, look, we're aware that inflation eats away at the real value of money. How do we protect that? I also think metals are getting a bit of a boost from Bitcoin struggling here. Bitcoin's supposed to be that great inflation offset, struggling even as risk assets have recovered, putting more and more behind the credence that precious metals is a wonderful way to protect purchasing power.
All right. So, you know, silver, gold, platinum, palladium, copper. What are your picks?
Oh, right. So one of them I really like is Rio Tinto. It's more on the industrial metal side, right? It's the copper, the iron ore, a little bit boring. They are just getting into lithium, but they're 50-50 joint venture owners with BHP on the Resolution copper mine, going to be the largest U.S. copper mines out there as we're looking to continue to protect our natural resource production domestically. I love where Rio's sitting, and it's relatively cheap, right? Only up 38% this year compared to other miners. So I look at it, wonderful dividend, fantastic balance sheet, really high quality global assets. Rio's a great way to play those industrial metals. And then when we look on the precious metal side, there's two stocks and two different ways I like to play this. One side is Newmont, just a pure play gold miner, fantastic gold miner, had to do some divestiture of some non-core assets, but they get about another $516 million in revenues when the gold price goes up about $100 per ounce. So do the math. We're expecting revenues to rise. We like what they've done on paying down debt, on divesting non-core assets. And the other one is Wheaton. Now, Wheaton's a bit different, right? This is a precious metal streamer. And what does that mean? That means that they front money to mines. They say, here's a big old bunch of money, hundreds, if not billions of dollars to help you develop the mine. For this, we will take a fixed price cost for metals in the future. This means for the last 10, 15 years, they've been helping mines invest. They've been helping mines develop, and now it's paying off tremendously. Wheaton, to me, is a fantastic way to play both gold and silver prices, and they partner with most everybody across all the big metals mining across the globe.
That's fascinating. And then, you know, quickly on oil, and, you know, I heard a little bit of frustration from Bill Smead about this yesterday. Obviously, they've been big energy investors for a long time, but he basically said he thinks the administration is really trying to keep oil prices down through a variety of geopolitical tactics, emptying the SPR, whatever you call it. If you believe that, I can't imagine you'd want to be very positive on it into next year. That said, Jeff, Curry, others have said we're going to get at a point where the supply glut we evidently are in runs out and the price starts to go up again. I'm just curious where you fall if you have an instinct one way or the other.
I'm not super bullish on WTI or Brent. I think you could see some downward pressure there. I think most everybody's saying short of a bad geopolitical event, we are oversupplied. Everything looks a little bit oversupplied. So either OPEC needs to play nice and start balancing and make some production cuts, or we're going to look at WTI stuck in the 50s, which isn't amazing for producers. There are ways to play this. One of them I love right now is Chevron. I also see Chevron as a hedge against Venezuela. Chevron's one of the only players in Venezuela. They managed to keep their license. They are legally producing in Venezuela. They have a special license from the Trump administration. If we see any changes in Venezuela, they're going to be one of the first people there that actually have boots on the ground and knowledge of how to deal both with local authorities as well as the local resources. They also have Guyana, right? They bought Hess, and Guyana to me is the best find in the last 20 years. And so, yeah, am I bullish WTI? No. If you want some yield in an oil play, I think Chevron's one of the best big integrated oils to pick up a little exposure there, just in case there's some tail end risk in oil.